Welcome to This Explainer. Today we're diving into the hidden, almost invisible psychological rules that completely dictate how you and I spend our money every single day. I mean, have you ever wondered why you might happily blow a $100 lottery winning on a fancy dinner, but you literally wouldn't dream of taking $100 out of your savings account to do the exact same thing? Well, today we're going to answer that exact question by exploring the fascinating world of mental accounting.
Section 1. The Rationality Illusion. Let's start by totally shattering the classic economic illusion that humans act like perfectly rational, calculating robots.
Because we don't. Picture this. A couple goes fishing, catches some gorgeous salmon, packs it up, and sends it home on a flight. Tragically, the airline loses the fish. But they compensate the couple with a check for $300. So what do? They take that money, go straight out to dinner, and spend $225. Now, this is an amount they had never, ever spent at a restaurant before. This hilarious little anecdote shows us exactly what happens when money gets a shiny new label called a windfall gain. Think about it. If they had just received a normal, everyday salary increase, that money would have gone straight to groceries or paying the electric bill.
See, standard economic theory says a dollar is a dollar. Money is supposed to be completely fungible, meaning every single dollar can be perfectly substituted for another. But mental accounting, it proves we treat money totally differently depending on where it came from. We assign these powerful emotional labels to our cash.
Okay, Section 2, the pleasure machine. Let's talk about financial emotions. Our brains are literally hardwired to process financial emotions completely differently than pure math. It all boils down to what's called the value function. We don't evaluate our finances based on our absolute total wealth. Instead, we care about perceived changes. We look at outcomes as gains or losses from a very specific reference point. And here's the real kicker. A loss stings so much sharper than a win feels good. Losing $100 hurts significantly more than finding $100 feels great. We're essentially just pleasure machines trying our hardest to maximize good feelings and minimize that sting. So knowing that, how do we manipulate our own feelings to game the system? Behavioral economist Richard Thaler identified 4 compounding rules we use. Number 1, segregate gains. Number 2, integrate losses. Number 3, cancel losses. And number 4, segregate silver linings. These 4 rules are basically the master code for how we manipulate our own psychology to maximize happiness and minimize financial pain. Let's look at some real data to prove exactly how we pull this off. I'm going to put you in the hot seat with a quick Socratic thought experiment. Mr. A wins 2 separate lotteries, one for $50 and one for $25. Mr. B wins a single lottery for $75. Both men walk away with exactly $75 in their pockets, right? The math is identical. But who is happier? Just think about your own answer for a second. The survey results beautifully illustrate that first rule. A massive 56 people chose Mr. A, while only 16 chose Mr. B. We absolutely love it when gains are segregated. Experiencing 2 separate, distinct wins just feels emotionally so much better than one big win. It's exactly why you really shouldn't wrap all your Christmas presents in one giant box. You gotta spread out the joy.
All right, let's flip the script. Let's test how you react when the money is flowing in the opposite direction. Mr. A gets 2 separate IRS tax bills in the mail, one for $100 and one for $50. Mr. B gets just one IRS bill for $150. Again, the math is perfectly identical. But who is more upset? Well, the results are undeniable. An overwhelming 66 people chose Mr. A as the more upset person. Only 14 chose Mr. B. And here we have the proof that we refer to integrate our losses because every individual loss comes with a sharp, immediate sting of pain. We would much rather just rip the Band-Aid off and take one big hit than suffer the agonizing pain of multiple, smaller charges. Honestly, it's the exact reason credit cards are so appealing. They pull a bunch of small, painful losses into one integrated loss at the end of the month.
Section 3, the value of a deal. Let's see how these utility types explain why we are so incredibly obsessed with getting a bargain. Okay, so every purchase actually has 2 kinds of utility. First is acquisition utility. That's just the value of the good compared to its objective cost. Simple enough. But the second one, and this is far more powerful, is transaction utility. This is the psychological joy or pain of the price compared to what you actually expected to pay, what we call a just or reference price. You see, you don't just consume the product itself, you consume the transaction, and you desperately want it to feel fair. Picture yourself in the scenario, because this is where the theory gets dangerously relatable. You're lying on a hot beach, and you are just craving a nice, cold bottle of your favorite beer. A friend offers to go grab one for you. Now, in one version of the scenario, he's buying it from the only nearby place, a super fancy resort hotel. In the other version, he's buying it from a small, kind of run-down grocery store. Your friend says he'll only buy it if the price is equal to or less than what you tell him. Before we look at the data, answer this for yourself. Does the actual building the beer comes from change its value to you? What's the maximum price you would tell your friend to pay for that exact same beer? Boom, here's the punchline. The median price given for the fancy resort was $2.65, but for the rundown grocery store, it was only $1.50. Guys, it is the exact same beer, consumed on the exact same beach, but paying $2.65 at a grocery store feels like an absolute ripoff because your reference price for a grocery store is much, much lower. The transaction utility is incredibly negative, which makes you reject a price you would gladly pay at a fancy resort.
Section 4, the mental budget. Because we don't just mentally label our income, we rigorously categorize our spending too. Consider this couple. They've saved $15,000 for a dream vacation home, and it's earning 10% interest in a bank account. Great! But they just bought an $11,000 car and financed it with a loan charging 15% interest. Now, this sounds mathematically insane, right? They are literally losing money on the interest spread. But psychologically, it's a brilliant, if costly, self-control mechanism. We build these really rigid mental envelopes because we honestly don't trust ourselves to pay our savings account back. If they drain the vacation account for the car, they know that money is gone for good. But they know for sure they'll pay the bank back.
Section 5, the psychology of pricing. Let's uncover how clever marketers completely exploit these exact cognitive blind spots.
Take the 1984 Super Bowl. It completely sold out all its tickets at a face value of $60. Meanwhile, out in the parking lot, scalpers were easily charging $300 or more. The obvious question standard economics asks is, why on earth would the NFL willfully leave that much money on the table instead of just charging the true market-clearing price of $300 to begin with? Well, the answer is that businesses know they absolutely cannot cross your fairness threshold. If the NFL charged $300 right out of the gate, fans would feel intense negative transaction utility. So, how do businesses raise prices without causing total outrage? There's a specific playbook. 1. Increase the perceived reference price by adding luxury. 2. Tie the sale to a larger purchase, like bundling that Super Bowl ticket with a massive hotel package. Or 3. Obscure the normal reference price entirely, which, by the way, is exactly why movie theaters sell you candy in those bizarrely giant boxes you never see at the grocery store. Section 6, the perfect gift. Let's wrap up this explainer by looking at something we all do, the art of giving gifts. Take Mr. S. He admires a beautiful $125 cashmere sweater, but decides not to buy it for himself, feeling it's just a bit too extravagant. Later, he receives that exact same sweater from his wife as a birthday gift, and he is absolutely thrilled. The catch? They only have joint bank accounts. Mathematically, he bought it with his own money. But this brilliantly illustrates that the absolute best gifts are luxury items we desperately want, but have strictly forbidden ourselves from buying with our own mental budgets. The act of gifting totally bypasses our internal accountant. This entire framework of human irrationality stems from the really groundbreaking research of Richard Thaler, as published in this paper by Informs. His work completely, fundamentally changed how we understand consumer behavior, proving once and for all that psychology and economics are intimately intertwined. So as you go about your week, I want to leave you with this final, somewhat provocative thought. Which of your financial decisions are driven by pure logic and which are just trapped in a mental envelope? Start noticing those invisible labels you put on your own money, and you just might find yourself making smarter choices. Thanks so much for learning with me today on this explainer.